This isn't a weak dinar, this is a clogged dollar pipe. And the moment the parallel rate started widening, the market basically admitted something the official scoreboard can't show. Access is failing faster than confidence. The official rate can sit there looking calm, tidy, managed, while the street price is doing something completely different. Because the street price isn't a debate about what the dinar is worth in theory. It's a receipt for what a dollar costs right now in real time. When someone needs to pay for a shipment, restock shelves, clear a container, or just protect cash flow for the next 2 weeks. And that spread, official versus parallel, doesn't widen because people suddenly woke up greedy. It widens when the marginal buyer can't get filled through the normal pipe and gets forced into the messy one. That's where the real pressure starts. Over the last stretch, the parallel market jumped hard. Prints in the 1,480-ish neighborhood per dollar were getting talked about, while the official channel basically didn't flinch. If you've watched pegged or managed FX regimes anywhere in the world, you know what that combination usually means. The administered price is still being defended, but price discovery moved off the official screen. And when price discovery moves, it doesn't do it politely, it does it violently. Because the parallel market is the deliver now market. It's the physical market, not the paper quote. And that difference matters more than any headline this week. But that's not the part that matters most. The underappreciated detail, the one mainstream coverage tends to skip because it's boring until it breaks things, is brutally mechanical. The rules around trade processing and customs clearance tightened right as the calendar flipped. So the banking channel that converts dinar into dollars for imports started behaving like a gate, not a faucet. The market didn't just panic, it got bottlenecked. And once you understand that, you stop asking, is the dinar doomed? And you start asking a better question, how fast can the pipe unclog? And what happens to prices while it's clogged? Because if this one choke point doesn't ease, the math changes. Here's the core setup in plain terms. Iraq runs a managed exchange system where the official rate is effectively administered through the central bank's mechanisms and bank channels, while the parallel market is where a lot of the real-world friction shows up. Cash demand, informal settlement, timing mismatches, and the things that happen when paperwork and compliance don't line up with the speed of commerce. In stable periods, that spread can be contained. In stressed periods, it becomes a billboard. And right now, the billboard is flashing. The widening isn't just a currency story, it's a trade finance story, a working capital story, a microstructure story. And microstructure stories move fast because they're about who can transact today, not who has the best thesis for next year. That's why you're seeing imports get pricier in a way that feels sudden, not because every importer woke up and decided to raise prices for fun, but because the importer's actual cost of acquiring dollars, after delays, after extra steps, after uncertainty, just went up. And once the marginal importer reprices, everyone else follows, because inventory has to be replenished at the new replacement cost. The next detail is what flips the whole setup. When replacement cost jumps, even people who don't need dollars today start front-running the need for dollars tomorrow. They buy earlier. They hoard. They pull demand forward. That behavior is rational at the individual level and destabilizing at the system level. That's reflexivity, and it's exactly how a temporary bottleneck can start acting like a bigger problem. Now let's talk about the latter that almost nobody explains cleanly. In practice, there isn't one rate. There's a chain of rates and costs. Think of it like this. The budget might be anchored around one number, call it 1,300 per dollar as an official reference point. Banks might have access around a slightly different level, say 1,310 in some frameworks. And the end user experiences something closer to 1,320 once fees, compliance friction, and process costs show up. That's normal in a managed system. That's the baseline spread created by the system itself. The problem is when you suddenly see the street market printing numbers that are not just a little higher, but meaningfully higher, and doing it fast. Because that implies the official ladder is no longer setting the marginal price for dollars. The marginal price is being set by whoever has actual deliverable dollars in hand, right now, and how much they're willing to part with given uncertainty. And when dealers sense uncertainty, they don't just raise the price. They widen the bid ask, they protect inventory, they ration. That's why you'll often hear different prints from Baghdad, Erbil, Basra, even on the same day. It's not chaos, it's liquidity thinning. And liquidity thinning is the silent accelerant. But that's not the part that matters. The bigger engine is the why now calendar trigger. These kinds of events love calendar pivots. January is a classic. New rules go live, new enforcement begins, new paperwork standards start being applied with fresh seriousness. Add in month-end and salary timing, where people and businesses anticipate cash needs, and you have a recipe for a sudden scramble. When a system changes at the turn of the year, you don't just get a one-day adjustment. You get a wave. First confusion, then workaround attempts, then choke points, then a rush to the parallel market, then price pass-through into goods. That wave can run for days or weeks, depending on how quickly institutions adapt and how flexible policy is. And if the market senses that adaptation is slow, it doesn't wait. It tries to price the worst case first. Because markets don't like uncertainty. They charge extra for it. That's the premium you're seeing in the parallel rate. And that premium is not sentiment. It's a fee the market is charging for unreliable delivery. So what changed mechanically? The key phrase you need in your head is trade processing and customs duty clearance being tied more tightly to remittance execution. Think Asecuta, automated customs processing, and the idea that banks are being required to see customs duties cleared or verified in a structured way before processing certain dollar remittances tied to imports. If you buy or ask if you're an importer, and the system now says, clear duties first, or prove clearance in this digital customs environment, that means your working capital gets trapped earlier in the chain. Before, you might have been able to move funds, settle, and then deal with parts of the customs process with more flexibility or with different timing. Now, timing matters. If you can't clear a step, you can't progress. That's a gate. And a gate doesn't just slow down bad actors. It slows down everyone in the queue, including legitimate businesses that simply aren't set up for the new workflow yet. And when legitimate businesses can't access dollars through the bank channel on time, they do what businesses do. They find an alternative channel. The alternative channel is the parallel market. But here's the trap. The parallel market is smaller and more price sensitive. It doesn't have infinite depth. So a shift in demand from the official channel to the parallel channel creates outsized price movement. This is the same dynamic you see in commodities when futures pricing looks fine, but physical premiums jump because delivery is constrained. Paper says one thing, physical says another. The spread is telling the truth, and you can literally map the transmission. Step 1, new enforcement or processing rules tighten remittance throughput. Step 2, importers experience delays, uncertainty, and missed windows. Step 3, to avoid losing shipments or missing inventory cycles, importers bid up cash dollars in the street. Step 4, the street rate jumps, and the bid-ask widens because dealers protect inventory. Step 5, replacement cost for imported goods rises, and retailers start repricing as old inventory clears. Step 6, consumers feel it, confidence shakes, and more people try to convert Dinar into dollars, just in case, adding an extra layer of demand. And that's where the real pressure starts, because the last layer is psychological, not mechanical. The market stops being only about imports and becomes about expectations. But that's not the part that matters most, because expectations can reverse quickly if the pipe reopens. Now, if you're skeptical, good. Skepticism is healthy here. The question is, do we have proof that this is a bottleneck event and not a pure macro blowout? Let's stack it. Proof point 1 is the speed and shape of the move. Macro collapses tend to be messy and persistent, with multiple data points deteriorating and the official framework losing credibility. Bottleneck events tend to be sharp, sudden, and tied to identifiable operational triggers. This move smells like the second kind: quick widening, big parallel prints, and a narrative that points to processing frictions and enforcement shifts rather than a sudden confirmed depletion of reserves. Proof point 2 is geography. When multiple major hubs are printing elevated street prices in parallel, that indicates broad demand pressure and system-wide friction rather than a single localized rumor. Proof point 3 is institutional messaging and policy posture. Authorities aren't acting like they've lost control of the macro anchor. They reacting like they trying to force dollar demand into specific regulated lanes, restricting domestic dollar use, emphasizing electronic payment rails, pushing transfers through globally recognized banking channels. That's an enforcement and formalization storyline, not a we ran out of dollars storyline. Proof point 4 is the way imports are repricing. Import price spikes following parallel rate widening is exactly what you expect when the marginal importer is forced to source dollars at a premium due to timing and compliance gates. Proof point 5 is the pattern we've seen in other managed FX environments. When a government tightens access, a parallel premium appears. When access expands, it compresses. The premium is the meter. And the next detail is what flips the whole setup. Meters can swing wildly even when the underlying tank is full if the valve is stuck. A country can have reserves and still have a parallel premium if distribution is constrained by policy, compliance, or operational friction. So you need to watch the valve, not just the tank. That's why bringing in the institutional lens matters. International observers have pointed out that when trade finance is routed through structured correspondent banking channels, and the system is functioning smoothly, spreads between official and parallel rates can narrow. That's not an ideological statement. It's a plumbing statement. If official channels can meet legitimate demand in time, the parallel market loses leverage. If official channels can't, the parallel market becomes the marginal supplier and sets the premium. And here is the part that makes this week different. The enforcement intensity and the integration of customs processing with banking execution created a timing shock. Timing shocks are vicious because they create real-world deadlines. Ships arrive, warehouses charge, retail shelves empty. Companies don't get to say, we'll wait until next quarter for the FX market to calm down. They have to transact. So they pay up. They pay the premium. And that premium becomes the new reference for the next transaction. That's reflexive. That S, why it can feel like it, S spiraling even if the root cause is fixable. Let's zoom into the market structure for a second, because this is where retail investors and macro watchers usually miss the signal. If you only look at the official rate, you're looking at an administered price. It's like looking at a government-set price cap. It tells you policy intention. It does not tell you marginal clearing conditions. The parallel market is closer to the marginal clearing market, but it's also where noise and rumor can amplify. So you need a way to separate signal from noise. Here's one. Watch whether the spread widens alongside widening dealer spreads and inconsistent prints, which indicates genuine liquidity stress, versus widening spread with stable dealer spreads, which can indicate more rumor than scarcity. Another way, watch whether import-dependent categories start repricing widely. When import prices jump across multiple categories, not just one, this is less likely to be a single rumor wave. And another tell, watch whether the system announces operational adjustments, delayed enforcement, phased implementation, expanded channels, new windows for duty clearance. Because if the problem is mechanical, the solution will be mechanical. And if they do nothing, the premium persists. Because if this one level breaks, the math changes. Now let's talk about arbitrage, because people always ask, why doesn't someone just buy dollars at the official rate and sell them on the street until the gap closes? That question assumes frictionless arbitrage. Iraq's system is not frictionless by design. If access to official dollars is gated through compliance, documentation, and trade verification, then the people who can access official dollars can't necessarily flip them freely. The system is built to limit exactly that behavior. So the parallel premium can persist because the arbitrage pipe is intentionally constricted. In other words, the market is segmented. Segmented markets can have multiple prices for the same thing. That's not exotic, that's normal. And it means the spread is not free money. It's a sign of constrained transfer between segments. So when you see a parallel rate spike, it's often because demand is forced into the segment with the least depth. And if the official segment's throughput slows, the forced demand increases. That's the squeeze. Not a gamma squeeze. This isn't options hedging, but a liquidity squeeze, a delivery squeeze, a throughput squeeze. And those can gap. So what does this do to imports practically? Imagine you're an importer. You have a shipment cycle. You buy, ship, clear, distribute, and you need working capital to keep that cycle moving. If the new process forces you to clear duties earlier, or forces you to prove clearance in a specific system, before a bank executes remittance, your cash gets tied up in a different sequence. That can create a mismatch. You might have Dinar on hand, but you can't turn it into dollars fast enough through the bank, or you can't complete the paperwork in time, so you face a choice. Miss the shipment window and risk stockouts, or pay the parallel premium and keep business alive. Businesses pay, then they pass it through. And because they don't know if the premium will persist, they add a safety margin. That's how a currency premium becomes an inflation impulse. Not theoretical inflation, store-level inflation. And once consumers see price changes, they start to anticipate more changes. They accelerate purchases. They hoard staples. They convert savings. That's the psychology layer. But that's not the part that matters most, because psychology can be stabilized if the system restores predictable access. So here's the uncomfortable truth. You can have two narratives that are both partially true. Narrative 1, the dinar is under pressure. Sure, any widening parallel premium is pressure. Narrative 2, this is largely operational and policy driven, and also plausible, especially with a clear calendar trigger and a clear mechanical gating story. The question is, which narrative dominates over the next 1 to 2 weeks? That's the near-term battlefield. And this is where we need to talk about the counterpoints and the ways this can get uglier, because you don't get trust by pretending there's no downside. If oil revenue disappoints, if fiscal stress rises, if regional dynamics disrupt inflows, or if enforcement pushes too much trade into the shadows, the premium can persist and even intensify. And if a parallel premium persists long enough, it starts to affect behavior in ways that can become self-fulfilling. Businesses reprice. Consumers dollarize informally. Cash demand rises. The system fights dollarization, which can tighten access further, which can widen the premium further. That loop exists. It's a real risk. But it's not destiny. It's a scenario. And scenarios are what you should trade mentally, not certainty. Because if you're trying to make decisions in an environment like this, certainty is the most expensive luxury. Now let's get tactical, because if you're listening to this, you don't want a lecture. You want a roadmap for what comes next, and you want it tied to mechanisms, not vibes. Over the next week or two, There are 3 price zones and 2 structural tells that matter more than any dramatic clip on social media. Price zone 1 is the area where the parallel market starts to show signs of stabilization. Call it a retreat from the extreme prints toward the low to mid 1/400s if the bottleneck eases. If you see that kind of move alongside narrower dealer spreads and more consistent city-to-city prints, that's a sign the pipe is clearing. Price zone 2 is the sticky premium zone, where the market stops spiking but refuses to mean revert, hovering elevated with choppy sessions. That often means throughput improved a little, but uncertainty remains. Price zone 3 is the danger zone, renewed spikes toward the highs with widening spreads, which suggests either the bottleneck worsened, or new demand hit the parallel market, or confidence took a psychological hit. And here's the first tell. Watch for operational adjustments and the pace at which banks can execute trade-related remittances under the new framework. If throughput increases, the premium should compress. Not immediately, not magically, but it should. And here's the second tell. Watch for import price behavior and availability in retail channels. If shelves stay stocked without aggressive price jumps in the next restocking cycle, the system is absorbing. If shortages show up and prices jump again on the next replenishment wave, the premium is biting deeper. And that's where the real pressure starts, because scarcity changes behavior faster than news. Now let me give you the 2 scenario lens, because it's the simplest way to stay sane. Scenario 1 is controlled pullback and retest. In this case, the parallel rate premium was a shock response to a policy and processing transition. Authorities and banks adapt. Workflows smooth. Importers regain predictable access through official channels. You'll still see scary prints, but the trend signal is mean reversion. Scenario 2 is continuation, squeeze, and gap risk. In this case, the bottleneck persists or expands, or enforcement creates a deeper shortage of deliverable dollars in the street market. At the same time, consumers and businesses pull demand forward. The premium remains elevated and occasionally spikes, and import prices keep creeping up in waves as new inventory is repriced. In this scenario, the market can gap on rumor alone because liquidity is thin and everyone is positioned nervously. And here's the key. Both scenarios can include scary volatility. That's why you need to separate trend signal from noise. The trend signal is whether the system restores throughput and compresses the premium over multiple sessions. The noise is the day-to-day spikes that happen in thin markets where dealers widen spreads because they can. The next detail is what flips the whole setup. Volatility itself becomes a weapon against you if you don't have a psychological shield. So let's build that shield quickly, because this is where most people lose money or make bad decisions, even when their thesis is directionally right. Volatility is how the market extracts impatience. When prices whip around, your brain starts telling you stories. It's over. It's unstoppable. I'm late. I'm trapped. Those stories are not analysis. They're cortisol. In FX stress episodes, the crowd tends to do the worst possible sequence. They ignore the early mechanical signal, then they panic buy dollars after the move is already extended, then they get shaken out when the system temporarily stabilizes, then they chase again on the next spike. That's how people turn a manageable risk into a chronic wound. Your antidote is structure. Pick your indicators. Stick to them. If you're watching the parallel premium, watch its behavior over multiple sessions, not a single print. Watch whether dealer spreads are widening or narrowing. Watch the operational tells. Watch import price pass through. And decide in advance what would make you change your mind. Because if you don't pre-commit to an invalidation signal, you'll let the market choose your emotions for you. And the market is not your therapist. It's a predator with a smile. Here's what invalidation looks like for the bottleneck thesis. If the system reports improved processing and you still see the parallel premium widening persistently, and you see broad shortages and accelerating pass-through into goods, despite claims of smooth throughput, then the problem may be more fundamental than a temporary gate. If you see a sustained and growing gap with no credible operational adjustments, that's a warning. On the other hand, what confirms the bottleneck thesis is boring. Consistent compression of the premium, fewer extreme prints, stable retail pricing after the next inventory cycle, and fewer reports of remittance delays or customs-related bottlenecks. Boring is good. Boring is stability. And if you're in the metals and commodities crowd, you know this pattern by a different name. When physical constraints ease, premiums collapse even if the long-term macro story stays intact. This is the FX version of that. Paper can stay calm while physical gets chaotic, and then the moment delivery normalizes, the premium deflates. But that's not the part that matters, because even in the good scenario, the market can still whip around and punish impatience. Now, a quick note for the skeptics of institutions, because I know you're here. Yes, incentives matter. Of course they do. Institutions prefer order. They prefer channeling flows through systems they can monitor. Formalization is a control mechanism, but don't turn that into cartoon certainty. You don't need conspiracy certainty to explain this move. You only need incentives plus microstructure. If policy tightens access, the market pays a premium for access elsewhere. If policy eases access, that premium compresses. That's the entire game. Incentives set the rules. Microstructure sets the price in the moment, and the market is in a moment right now where the rule change hit faster than the system's ability to absorb it. That mismatch is where volatility is born, and that's where the real pressure starts. So what do you do with this information if you're watching from the outside, as a macro observer or a retail investor trying to understand the signal? First, don't confuse the official rate with the marginal price. The official rate tells you policy stance. The parallel premium tells you friction. Second, don't confuse a parallel premium with a guaranteed one-way bet. These spreads can compress hard when policy and operations adjust, and they can compress when the market simply runs out of incremental buyers at the top. Third, anchor your attention to the calendar. The week after a major policy or workflow change is when the market tests the system. If the system passes the test, the premium should cool. If it fails, the premium becomes embedded. Fourth, watch for the next wave in goods pricing, because it often comes with the next restocking cycle, not immediately. People often think the moment the FX rate spikes, shelves reprice the next hour. That's not how inventory works. There's a lag. That lag is your clue. If you see repricing on the next replenishment wave, the signal is stronger. If you don't, the spike may have been more about fear and short-term scarcity than a deep structural shift. And that's not the part that matters most, because the most important outcome in the near term is whether the market relearns that dollars can be obtained predictably through the official channel. Predictability is what crushes premiums. Now, if you want the cleanest what to watch next week checklist without getting lost in noise, here it is in plain language. Watch whether street quotes stop making new highs and start clustering more tightly. Watch whether the spread between buying and selling prices on the street narrows. Watch whether chatter shifts from no dollars available to dollars available but expensive, and then to dollars available normally. Those are stages of stress unwinding. Watch whether businesses complain less about being unable to execute remittances. Watch whether any adjustments are announced around duty timing or processing friction. And watch the emotional temperature. Are people talking about converting everything right now, or are they calm enough to wait? When the crowd calms down, premiums compress. When the crowd panics, premiums widen. That is why your job is not to be the calm person in the room for aesthetic reasons. Your job is to be calm because it's profitable to not donate your decision-making to volatility. And here is the final twist, the one metric everyone must watch. Not the Dinar in isolation, but the gap between the administered rate and the marginal access rate, and how that gap behaves around operational checkpoints. If you want to know whether this is healing or worsening, don't ask for more opinions. Watch the premium, watch the throughput, watch the pass-through into imports, because those three are the living pulse. And if this is a bottleneck that's going to clear, the premium will start to leak out of the system like air from a punctured tire. Slow at first, then faster, then suddenly everyone acts like the panic never happened. If it's not going to clear, the premium stays sticky, and the economy starts to adapt to the premium as if it's permanent, which is when the real damage accumulates. That's the fork in the road. And if you're here for the long game, you already know the rule. You don't need to predict perfectly. You need to watch the right signals and avoid getting emotionally farmed by the noise. One last thing before we close, because it matters for trust. Price can whip around violently, even if the thesis is correct. You can be right on the mechanism and still get punished by timing. That's normal in stressed markets. That's why the only sane approach is to treat this as a dynamic situation with confirmation signals, not a one-time proclamation. Base case, squeeze case. Controlled pullback and retest, or continuation and gap risk. The market will tell you which one you are in if you listen to structure instead of headlines. And if you want to be part of a community that actually does that, who watches the plumbing, the spreads, the incentives, the calendar, and the real-world symptoms, then stay close this week. Because the next few sessions are exactly when these systems reveal whether they can absorb a rule change or whether they were about to force another repricing wave. And that's where the real pressure starts.